What is one sign that a franchise is struggling? Well, if you look at the model, typically they're so attractive because they are asset light. And so in my view, a sign that a franchise is struggling would be they purchase franchise locations and own them under the corporate umbrella. Who's doing that? Well, I can tell you, it's not McDonald's, it's actually Burger King. Burger King has struggled in recent years, and there was a big announcement that they are buying one of their franchisees to convert it to corporate-owned locations. Why are they doing that? What do they hope to gain? What else is going on within the brand? Stay tuned, and we'll talk about that more here. When I say asset light, what I mean is that, you look at McDonald's or Burger King, they have all these locations and they don't really own many of those locations. They charge royalties and they charge fees from the franchisee for marketing and advertising. They'll have corporate headquarters and whatnot, but in terms of fixed assets, a lot of these companies really don't. Now, McDonald's has a slightly different model that perhaps we can get into in a different video, but generally speaking, in terms of the operations, these companies are really relying on their franchise base to most or almost all of the heavy lifting. If you've subscribed to my channel, you might see that there's at least a slight focus on QSR. So whenever we saw the news that Restaurant Brands International, the owner of Burger King, announced a big acquisition of one of its franchisees, we were definitely very interested. Restaurant Brands International doesn't just own Burger King, Popeyes, Firehouse Subs, as well as Tim Hortons. In terms of this acquisition that was just announced, it was a $1 billion transaction for a little over 1,000 units of Burger King within their system. Now, how big is that? It's actually about 15% of the total US footprint. There's just shy of 6,800 units in the US, per the latest figures that I was able to see. What's interesting is the target, Carroll's Restaurant Group, is actually public as well. Restaurant Brands International agreed to pay them a 23% premium over the 30-day moving average. The day that the deal was announced, it was a 13% premium to the stock price. So what did the company say whenever they were announcing this as to why and whatnot? Well, the big component of this, in my view, is that they are going to drastically speed up the pace of remodels to stores. So again, this group has about 1,000 stores. Burger King said, or Restaurant Brands International said, that they are going to try to get 600 of those units remodeled by 2028. Pretty fast pace to try and get through all of those by 2028. Additionally, what's interesting is that they expect to offload some of these units as time goes on, but the expectation as of now is that they are only going to release these in units or packages of around 50 or so. All this comes during a time when there's really a lot going on in the burger segment, in my opinion. Why do I say that? Well, a lot's going on with Burger King. They've been underperforming some of their peers. They're trying to shake things up with these remodels and new marketing initiatives. So clearly something's going on there. But who's the giant? McDonald's, obviously. They're even announcing changes. They're going through a process to try and revamp their burgers. Now, in my mind, whenever very consistent top performer announces that they're trying to improve one of their key products, it's pretty interesting. I don't know how it's going to take shape. I know that they just announced the reintroduction of a fan favorite, the double Big Mac, that I think has, instead of one patty on top and one patty on bottom, two patties on top and bottom. Probably a little bit more than I would be interested in eating in one meal. But anyway, that's one area that they're trying to innovate, if you will. So a lot's going on in the burger segment, and Burger King needs to innovate and change if they want to pick up that lost share. In terms of looking at the bigger picture, what are some of the key takeaways whenever you look at this transaction as it relates to maybe not just Burger King, but perhaps QSR in general? The first one for sure is that remodels are a big deal. If you look at one of the best performing chains, Chick-fil-A, their operating cash flow that they're throwing off annually at a given location is probably well well north of $1 million. I mean, it might be, you know, $3, $4, $5 million in some of those locations. So if you look at a remodel of one of those stores, you know, even if it's $250,000 to $500,000, I mean, yeah, that's still a healthy chunk of change, but it's not really going to put the company at risk, or it's not, you know, rising to that level of magnitude, you know, based off how much operating income they have. But I mean, if you look at smaller chains, you know, a Subway, for example, I mean, their operating income per store might be, I don't know, $50,000 to $100,000. If that really is the range, what would a remodel for a Subway cost? I mean, it might cost $50,000 to $100,000. So what you're looking at here is that depending on the franchise that you're in, the cost to remodel could be a very significant cost as it relates to your annual operating income. And, you know, where's the money going to come from? Can you pay it out of operating income? Do you have to take on some debt? I mean, it's tough to say. It's going to be situation by situation, but that's why I think the point remains is that remodels in the QSR space are a really big deal. You know, as it relates to Burger King itself, I would say you can make the argument that franchisees haven't bought in to the turnaround strategy. The reason why I say that is that, you know, if the operator of Carol's Restaurants, who again own 15% of the US locations, if they just, you know, wholeheartedly believe that, yeah, this is the right strategy, let's redo our stores, let's introduce new menu items, and they were just 100% on board with that, I mean, I think that they would have started remodeling the stores at a faster clip on their own. I don't think it would have taken the franchisor to come in and purchase them outright in order to speed up the remodels. Certainly could be wrong there. Could just be a mindset on the part of the operator of Carol's that, you know, the stores are doing pretty well. They don't need to be remodeled. But without that insider information, you know, that would be one takeaway that I would have, is that if they were fully convinced that remodels were the right route to take, they would have done that already and been well on their way. As it relates to smaller franchisees, you know, they might be looking to the big guys for guidance as to what they should do. You know, if you're a smaller franchisee, you might have seen Carol's Restaurants not doing these remodels, and you might have kind of thought, well, if they don't think they're worth it, you know, why should we do it? You know, we only own 1, 2, 3, 5 units. It's a lot bigger deal for us to close a restaurant than it would be for a mammoth like them. Well, for those smaller franchisees, I would say that, I mean, they're potentially be at risk for not having their franchise agreements renewed. Yeah, that's one of the key, you know, hammers, I guess you could say, or the, you know, if you think about a carrot versus a stick, you know, that's one of the sticks that the franchisor has, is that, you know, if the franchisee is not abiding by the franchise agreement, then there's a chance that the franchisor will not renew that franchise agreement. And then all of a sudden, your livelihood is gone. I mean, if you can't operate your store, it would be hugely consequential, because you don't have the operating income, but you probably still have the lease that you have to pay for. There might be other debt associated with it that you have to pay for. I mean, it could be completely devastating, you know, really scary to think about. Finally, I think the shift by Restaurant Brands International to focus on smaller franchisees, you know, definitely pluses and minuses to that strategy. And what I would say is that, you know, it's not uncommon for brands or companies, you know, to go from one side of the pendulum and swing all the way to the other. You know, if you look at Carol's, 15% of the overall portfolio in the US was owned by one franchisor. Is that too much? I would be honest with you, I was surprised to see that it was that high. You know, I think that perhaps, you know, something in the 5 to 10% range was more along the lines of what I expected. So I guess it's not super surprising to hear that, you know, after these remodels take place, they might want to offload those stores and break them up a bit. But to go so far as to package them in units of around 50, you know, that's really interesting. You know, again, let's contrast that to a brand that's on the other side of the continuum, which is Subway. You know, I mentioned numerous times before that Subway's model was really to try and keep the units controlled by one franchisee to be very small. Now that has, you know, the pendulum for Subway has started to shift the other way towards larger franchisees, because they're seeking that sophistication. Now, is Restaurant Brands, you know, is what they're trying to do to strike like a happy balance between, you know, having franchisees that have the operational sophistication to run those stores really well, but without getting too large so they lose what the franchisor is calling that connection to the local market. I mean, only time will tell there. I mean, I can't say that I think it's a terrible strategy. I can't say that I think it's the most amazing strategy. But again, you know, it's a strategic decision that the brand is taking. And with any strategic decision, it's probably going to have its pluses, it's probably going to have its minuses, and only time will tell if it really is the right decision for this brand. Now, I realize not everyone eats at Burger King, but what do you think? Do you think Burger King needs to revamp its store layout, the look, the cleanliness, or the brightness? Let me know in the comments. And if you like more videos on the QSR space, done a video on Subway and Quiznos as well. Now, I will say our general theme is private equity and M&A. So I do encourage you to subscribe to the channel, just knowing that you're probably going to see some more QSR videos in the future, as well as many more about buying a business and what private equity really is. Thanks for watching.